Canada Nickel, we are advancing the 100% owned Crawford Nickel project in Timmins, Ontario, in Canada. A couple things I want to highlight. First, the nickel market. We think that it's going to be pretty bullish going into the 2025 period with the push of the EV market. Canada Nickel, we put out a PEA back in May of 2021 that highlighted an NPV about 1.2 billion and a 16% IRR. Over the course of the year, we updated our mineral resource. We doubled the mineral resource to about 1.4 billion tons, grading 0.24 nickel. And because of that, we're going to have a feasibility out by year end that will have about between 1.3 and 1.8 billion tons through the mine plan. Again, our feasibility is due year end. And a key feature of our asset is that it is low carbon emitting. But on top of that, we've developed a process within our tailings where we can actually generate credits for sale. We've kicked off our permitting this year, and we expect to get our permits by 2025, with first production coming in 2027. But on top of that, we've also defined a pretty large district scale of a number of regional targets that we believe could be actually even bigger than Crawford. Just a bit on the team, led by Mark Selby, our CEO. He's a former ex-Inco, and he was also the CEO of Royal Nickel. He took that team at Royal Nickel after they fully permitted Dumont and to a shell, and he took that and brought him over to Canada Nickel over here. So this team has had experience in de-risking and taking projects to a shovel-ready position. Just a quick overview of our capital structure. We have about 22 million of capital available, of which 8 million is in cash. And we have 7 research analysts covering us. And just quickly on the nickel market overview, from now till 2030, we believe that roughly 5.1 million tons of nickel supply will have to hit the market to satisfy the demand at a minimum. If you believe Vale's estimate about 6 million, the numbers get even larger. And currently last year, we're doing about 2.8 million tons of demand. So basically the supply has to more than almost double to meet some of these EV demands that we're seeing from the auto manufacturers, and again, the continued growth from the stainless side. When you look at our project, we're located in Timmins, Ontario, Canada. It's a very well-known mining jurisdiction in Canada. 100-year operations with the Hollinger mine operated by Newmont in the center of the city. Within our area, there's actually a deep labor pool of talent, roads, hydro and nuclear power that provides us with clean and cheap power. And there's about 80,000 workers that are available to be hired if we were to get our project going. In terms of our PEA that we announced last year, again, 1.2 billion after-tax NPV with a 16% IRR. At peak nickel production, we'd be doing about 42,000 tons of nickel per annum, a life of mine of 34,000 tons a year. And our cash cost would be about $1.09 with all-in sustaining at about $1.94, which is pretty good margins here today at close to $13. In terms of our cash costs, we'd be a tier 1 first quartile operator at $1.09. And on a carbon emitting basis, we'd be only emitting 2.8 tons of CO2 per ton of nickel produced, which is, again, first quartile. In terms of our nickel resource size, we have measured and indicated resources of about 3.5 million tons. That puts us in a top 5 sulphide deposit globally. And at 42,000 tons of nickel production per annum, that puts us again in the top 5 of sulphide operations globally. So between our PEA and our feasibility study, there's a couple of areas where we see significant improvement. One I briefly highlighted was that resource expansion. We'll have the upper end between 1.3 to 1.8 billion tons through the mine plan. Secondly, would be recovery optimizations. Since we've tested, since our PEA, we've tested considerably more material, and we're getting substantially higher recoveries in the back of that. Thirdly, our net carbon, we'd be able to potentially generate some credits for sale, which would be a pretty good revenue stream for us. And again, we actually have byproduct cobalt and PGMs that we never included in our PEA that will be included in the study. In terms of the flow sheet, in our PEA, when we first put that out, it had a pretty low recoveries, around 37%. But since then, we've been seeing log cycles that show up to 62% recoveries in some areas, and on average, about 10 points better on almost all materials that we've tested. We're guiding to about 4 to 5% improvements in the recovery rates. And every 1% improvement is roughly 92 million of NPV value. So it's pretty sensitive to the improvement in recoveries. So a key feature is this carbon processing that we've kind of talked about. When we pull rock out of the ground, it comes out as that black rock that you'll see in the top image there. And over a course of a year, when we just let that rock sit there and let it do nothing with it, it forms that white magnesite that you see in the lower image there. And what's happening is that black rock is grabbing a CO2 molecule and naturally sequestering it, forming a magnesium carbonate over it. And when we let it passively sequester, it follows that red curve to the bottom left, where after roughly 200 days, you get to carbon neutrality. So what we've done is we've taken that black rock, we've crushed it, we've agitated it, and then we've injected CO2 directly into the process. And thereby that expedites that sequestering process. And after 36 hours, you get to that carbon neutrality. And after 6 days, you start generating credits for sale. We believe that we can potentially generate between up to 710,000 tons of CO2 credits per annum. And if you apply roughly a $30 to $50 credit value to that, that's about $20 to $40 million of additional revenue that we might be getting. Now, we've defined a pretty substantial footprint within Crawford. The lower image there to the bottom right is actually the mag anomaly of the geophysics survey we flew for Crawford. And we've identified a number of targets in the area that stretch over a 42 kilometer square district. Above that to the top is the Reed deposit we just started delineating. And if you look at that footprint, it's actually substantially larger than Crawford already, and we just started drilling that. Again, Crawford is 3.5 billion tons, so we believe that we potentially have multiple pods of very large deposits, all within a 100-kilometer radius of one another. When you look at M&A activity over the last mid-2000s, it's been pretty active, especially in the nickel space, where it's getting more active in the nickel space, highlighted by BHP and Wyloo bidding on Noront. And when you see these transactions that happen with in the nickel space, they all transact for in the multiple billions. We're currently roughly 150 million market cap, so there's a substantial re-rating process potentially. A couple of things to look for in 2022. We completed our financing in March. We've updated our resources in the middle of the year, and we started our permitting process. You'll see some, exploration updates. You'll see some permitting updates. You might see some more additional land acquisitions. But most importantly, you'll see our feasibility study due at the end of the year, likely an announcement in January of next year. But that's going to be the key event, and we'll have we're pretty confident in the results that we'll see are very comparable to what we had in the PEA. That's it for me.